Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about Twilio. So, Twilio is a platform that allows companies to communicate with their end customers. Okay, so it's a developer-facing platform, and it's really about driving engagement. So it started off as just a cloud communication platform, and now it's kind of trying to move on to driving engagement with the end customer. And what is particularly interesting here is that at 13 times forward sales, I don't think the stock is particularly cheap. So we're going to go through some of the pluses and minuses. We're going to go and highlight one of the aspects that I really don't like here, which is the company's trajectory towards negative profitability. So I'm just going to jump right in here. So, in the past several months, many stocks have kind of sold off, particularly in the last 2 months. So the fact that Twilio has sold off doesn't really, I wouldn't really that wouldn't be a thesis breaking reason for me on that basis alone. It's kind of interesting because what I said about just over a month ago, I said that Twilio was a stock that could do no wrong in 2020. At that time, any as a service tech stock, irrespective of underlying fundamentals, whether it was a content delivery network, which is CDN, or an e-signature platform as a whole, the market was so infatuated these narratives that any as a service business was became so alluring, and the share prices rallied. So I wrote this approximately 2 months ago, and in the last about 2 weeks ago, we just saw that obviously the famous e-signature platform, which is obviously I was referring to DocuSign, that blew up. And that's the thing here, right? So investors kind of become so infatuated with narratives, and it works on the two sides of the equation. So when people were in 2020, everyone was like pounding their chest saying, "Oh, 2020, 2020," and like I get that, and then the stock was going up and up and up and up, and now people are kind of like, "Oh, hold up, is it really worthwhile paying 13 times forward sales for Twilio?" So let's kind of unpick this slightly more here. So Twilio as a company, they're guiding for Q4 to be up 40% year over year. Now, this management team is obviously very conservative, and I get that. But however you play this out, there's a meaningful deceleration year over year. So even if they come up at 45%, you're looking at a 2,000 basis point deceleration compared to Q4 of last year. The other thing that I wanted to highlight is that um, it's it makes a big difference how Q4's exit rate is. If the company is able to kind of grow at close to 45%, yeah, that's great. Like people can say, yeah, we got strong confidence in that multiple. If it appears that it's slowing down and it comes up at, let's say, close to 40%, then that's a different multiple that investors will be willing to pay on the stock. We'll talk more about its revenue growth rates in a minute. So just one of the things I wanted to highlight is that Twilio is very acquisitive, and it's already on a run rate of 3 billion in revenues. Now, if you think about it, right, there are not so many businesses out there that Twilio would be able to buy that are cheap enough to for them to be able to add any value to, and also that big enough so that they can actually move the needle on the top line of the revenue growth rates. So it's going to be difficult. They've got a difficult time ahead. Now, what does Twilio do? So Twilio is a cloud communication platform, right? So its ability, it creates the infrastructure so that developers don't need to create the infrastructure. It creates the infrastructure so developers can just use that platform to drive engagement with the end customer. So if you think about it, its ability to harness insights from the customer so that you don't have to always kind of re-engage, don't have to always reacquire your customer. You can engage with the customer and you can retain that customer. So that's really the key here for the platform. Now, it uses different types of formats, and it's that ability to offer a personalized message for individual customers, whether it's on SMS or whether it's on voice or whether it's email. It's that ability to connect with different customers via different channels that Twilio really offers. And that's something that's very, very attractive. Now, a few things that I wanted to highlight is that these tools to drive engagement is not only Twilio. So I highlight one company here, Freshworks. Freshworks has recently done an IPO. Freshworks has one segment called customer engagement called Fresh Desk. Now, the Freshdesk is just one part of Freshworks, and it's kind of doing some of the stuff that Twilio offers. A closer competitor, which isn't doing fairly that well, but still growing, is Bandwidth. Now, irrespective of Bandwidth's share price, the company is doing quite well. Now, to be fair, a lot of what Bandwidth does is particularly targeted towards smaller and medium-sized companies. However, that being said, Bandwidth also has as customers Microsoft, Zoom, and Google. So if you think about it, yes, it is smaller, but it still kind of has big blue chips as well as customers. Now, this is the problem that I found when it comes to Twilio. Its path to profitability is moving in the wrong direction. You can see here the cash flows from operations for the 9 months ending in 9 months of ending Q3 2020, whereas positive 18 million of cash flows from operations versus negative 20 million this time around. So it was positive 17 million, 80 million last time around, negative 20 million this time around. And its guidance for Q4 is pointing towards negative 23 cents compared to positive 4 cents. So it's the fastest growing. It appears that it's becoming more and more unprofitable. Even if they come in at the end at, let's say, negative 16% and negative 16 cents for Q4, you're still left with the fact that in the previous year they were positive 4 cents. So it's again a story that they're growing, but it's not really translating into anything profitable. Growing, it's like revenues for the sake of revenue is just vanity, right? Now, here's the problem. The company is guiding over the next 3 years to grow at a compounded annual growth of 30% CAGR organically without any acquisitions. And now it's kind of starting to think like, is this really, really possible? So investors are asked to pay 13 times forward sales when the rest of the market is trading so much cheaper. There are many companies out there that are targeting approximately 30% CAGR and they're growing at, let's say, 10 times forward sales or even a single digit forward sales. So why would investors really clamor here at this price? I'm not talking about people that are shareholders and, like they're entrenched and like, I'm not talking about those guys or those girls, those shareholders. I'm talking about new shareholders coming to the stock right now. I'm looking through this and thinking, is it really worthwhile paying 13 times forward sales? So yeah, I'm dubious because the business is becoming so unprofitable that it's like, is it worthwhile paying for it? I'm not really sure. But if you want to find out what kind of names I'm particularly excited right now, don't forget to check out my marketplace. It's called Deep Value Returns. You can see what other people said, check out my reviews, and yeah, get engaged, drop a message. See you soon. Bye bye.